The most reliable bearish setup doesn't happen at the top. It happens after price has broken structure to the upside, when everyone's convinced the recovery is real. Today we read one full bearish cycle, from false bullish hope to the trap that springs and the violent rejection that follows. The chart opens weak, a lower low on the left. Then a higher low forms and price closes above the recent lower high, a break of structure. But it's a reclaim attempt, not a trend, and it looks identical to a real recovery early on. That's the trap. The volume on the break is only moderate. The first hint, it's fragile. Price climbs in textbook bullish structure, and this is where retail commits, some chasing the high. But the institution sees price running into a level its algorithms mark as supply, and rising retail buying, exactly the conditions to absorb a large sell position. What looks like continuation is the place they begin distributing. The two red lines at the top mark the order block. One high here, a second later at the same level, both reject. Two highs at one price means real supply that wasn't absorbed even after two attempts. Retail calls it a double top. The precise read is a confirmed supply zone, an active institutional sell program. Until it's exhausted, every approach should reject. From the cycle high, a large red candle drives down, and the volume below it spikes, one of the tallest red bars up here. The first rejection from the zone. The candle is big and fast. The drop happens in a few candles, and high volume on a sharp move is conviction. Supply was just delivered with size. Most read it as a pullback. It's the first delivery of distribution. The candles after build a clear pattern, lower high, lower low, a failed bounce, a deeper low, repeating across the middle. This is distribution confirmed. Both halves required, failed rallies and extended declines. And the volume is asymmetric, muted on bounces, meaningful on drops. Buyers aren't committing here, sellers are. A small bullish push prints a minor higher high. It looks like a recovery starting. It isn't. It can't reach far enough to break the dominant trend. Every minor high that fails to break the prior swing high confirms the downtrend still holds. And the volume gives it away, lower than the original break, buyers weakening. Then a sudden aggressive push drives price back up to the order block. The aggression is what makes it dangerous. It triggers fear of missing out, shorts cover, sidelines chase. It looks like a major reversal. The opposite is true. This push is the bait, the final wave of retail buying engineered to absorb the next tranche of supply. The more aggressive the approach, the more brutal the rejection. Price reaches the order block again. What happens next is the most decisive event on the chart. A huge red candle drives down with brutal force. The body one of the largest visible, and the volume below it dwarfs everything, the tallest bar across the full width. This is institutional rejection at confirmed supply, the largest tranche of the whole cycle, delivered at the exact moment retail is most committed. No non-institutional explanation exists for a bar this size. The candles after produce the steepest decline on the chart. Not grinding distribution, acceleration, lower, lows in quick succession. A third seller has joined, the trapped longs from the reclaim, now exiting at a loss. Institutions, earlier capitulators, and trapped buyers all delivering supply at once, with nothing to absorb it. The cleanest, most directional move of the whole cycle. Toward the right edge, the acceleration exhausts. A final lower low, the lowest point on the chart, on significant volume, with a long lower wick and a close well off the lows. Large volume, long wick, close above the lows, the classic capitulation signature. The last holders surrender, the final supply delivers at once, and the wick is institutions bidding into max pain. The bottoming signature, not yet the bottom. 3 things to carry from this chart. A bearish order block isn't a passive resistance line. It's an active accumulation venue. The aggressive reclaim is the trap, not the recovery. The more violent the push into supply, the harder it rejects. And the cleanest move comes after the rejection, when trap longs become a third source of supply on top of the distribution already underway. If reading charts this way is useful to you, subscribe to SMC Chart Sense for a new chart read every week. That's the best way to keep these in your feed.